Well, good afternoon, everyone. Welcome to the Cedarstone quarterly webinar. As you may recall, we are going to a quarterly webinar format rather than having our annual investor conference. So far, to be honest, we're excited about it. We've had much better attendance on the webinars. I think it's a little bit easier to just jump on for an hour or two on a webinar than it is to show up face to face. Looking forward to seeing all of you face to face when we can. But for the next hour or so, what we'd like to do is spend a little bit of time with you to discuss a quick market update and then walk through year-end tax planning. We've been working with many of you on trying to minimize your taxes for 2025 and look for opportunities within your investment portfolio. And so Carol will be walking through some of the key strategies that we've been utilizing and recommending to you all. But before we do that, let me start with our important disclosure. As we see every quarter, we will be making some forward-looking statements. Obviously, past performance is not an indicator of future performance, and any speculative statements, any future-oriented statements need to be taken as such and not as fact. These represent our opinion only. And so with that, let's walk through what's going on in the market. So first, let's walk through the year-to-date GDP. There's been many questions, and I think there's quite a bit of confusion out in the news on whether or not the economy is doing well or not. There's this perception that much of the stock market rally is based on speculation, an unwarranted enthusiasm for the stock market. And I would say that the stock market is expensive, but it is backed by some pretty good fundamentals. So let me share with you this one chart that I think does a good job of quickly summarizing some of the economic data. This is produced by the Atlanta Fed. It's called the GDP Now Real-Time GDP Estimate. And so what this chart shows is in blue, the blue chip economic forecast over time for the third quarter of 2025. And then, and you can see that the economists that they survey are forecasting a GDP estimate of about 2.5%. That's actually healthy growth for the third quarter. And that's what economists are forecasting. In green, you can see the Atlanta Fed's GDP Now estimate. And basically what the GDP Now represents is the Atlanta Fed populating their GDP numbers real time as that economic data is published. And so you can see that the current data coming into the Fed is actually better than most economists have predicted for the third quarter. And so, and actually at a very healthy clip, almost 4% for the third quarter is the GDP Now estimate. We'll know this number in the next few weeks. We'll get actual figures, but this chart does a good job of summarizing those underlying factors. Well, based on that, we can take a look at what the stock market is doing. The stock market is up 15%. That is reflective of the good economy, I would argue. Also, earnings are up 14% year over year so far, as the earnings are coming in over the last few weeks. And so S&P 500 is up 15% year to date, but that is also backed by some pretty strong earnings. Internationally, on our next slide, international markets have stalled a little bit. You may recall last quarter we discussed how international markets were outperforming the U.S. That trend has stalled as Europe continues to struggle, Japan continues to struggle, and in particular China continues to struggle. This is a chart of the German stock market, the DAX, and you can see that right around our last quarter's webinar, that just leveled out, and we've seen international markets start to struggle. In the bond market, interest rates have dropped. That's generally positive in the short term for bonds, and so bonds have actually had a pretty good year. The 10-year Treasury, which is what this chart represents, you can see just dropped below 4%. And so interest rates have come down. But the real big story of 2025, I would argue, and it is gold. And so you may recall that we did add gold to the portfolios back in May. And you can see on this chart just the tremendous rally that gold has had. Now, what everyone is asking about is the 5%, a little bit more than 5% pullback. It's difficult to see on this chart, but the gold price per ounce did peak at about 43.50, and then has dropped. Today, I believe we closed at 4,090. So that was quite a bit of a pullback. And so the question is the rally dead? Last quarter, we did show the next chart, which is the long-term view of gold. And you may recall, this one is a little bit difficult to read on your screen, but in the summer, you may recall that the gold rally had stalled, and the question was, hey, is the gold rally over because it's done nothing for the last 2-3 months? And that was really the time period. You can see in the middle of 2025, there was a period where gold did nothing, and then here since August, you've seen this tremendous run up. But notice how gold really got out of the channel and got ahead of itself, I would argue. Our year-end target for gold was $4,000, and so we were well ahead of where our expectation was, and I would argue that was based on the government shutdown and some geopolitical risks, in particular the China-U.S. trade tensions. As those two short-term events eased, I believe that what we have seen, and we will see a pullback to gold. However, our view is that this long-term trend in gold is still intact, and therefore our bias is to not try and trade any short-term pullback in gold, but rather hold on. And our year-end target for 2026 is $5,000 per ounce, and we do see a path that gold could reach those levels by the end of 2026. So let me just summarize then what we're seeing. So first, the economy and earnings continue to show strength, and S&P 500 earnings are up 14% year over year, really supporting the rally. International markets rallied at the beginning of the year, but are beginning to show signs of stress. Interest rates are falling, providing a tailwind to bond returns and helping the economy. And finally, gold's rally has become too hot, and the pullback, I would argue, is normal. The long-term trend appears to still be intact. So what could go wrong? All right. So there's plenty of things to worry about. But when the market is hot, I always like to consider, okay, what could disrupt this rally? Probably the number one item on the list is a U.S.-China trade war, and that's a very real thing. Negotiations are ongoing, but showing little progress, and both sides show little interest in backing down. If that were to ignite into a more serious trade war, that would be negative for the market. We need to be wary of that. Thankfully, I think that the gold does provide a good hedge in that scenario. And so I think the portfolios are well positioned. The second item is an inflation surprise. And what I mean by that is a inflation number that comes in higher than expected. The next CPI release is expected on the 24th. And the market is generally expecting about 3% on CPI. But if it were to come in hot, the market would react negatively to that. And related to that is the third item, which is an unexpected pause in Federal Reserve rate cuts. So one of the things that's supporting this rally is the Federal Reserve is lowering interest rates, has lowered interest rates, and is expected to lower interest rates further. The market is pretty much baked in at least one cut and really two before the end of the year, one in October and one in December. And if inflation comes in hot, that could give the Federal Reserve pause and the markets would react negatively. The next item that is on our worry list is a growth surprise. And so, like I say, my opinion is the economy is currently doing well, but the market is always forward looking. So if we saw some economic data coming out where a bad jobs number or a bad growth number, so when I say growth surprise, meaning slowing growth, that could derail the rally. And then lastly, worsening conditions in EU, Japan, and China. It's not hitting the U.S. news very much, but really, I would say as bad as it may seem in the U.S., there are some serious issues in the rest of the world. Debt in Germany and France in particular, Japan are struggling with sovereign debt issues. China has a property crisis that is as severe and significant as 2008 was for us. And so there are some risks that problems overseas could spill over to the U.S. And certainly there's other things that we could add to the list. There is still a war in Ukraine. There are significant issues around the globe that we could go through. But the items that are top of mind are these. So that's a very quick overview of what's going on in the market. We're very pleased that it's been a great year in the market, and so we're cautious and we're always looking for what could go wrong. But for now, the portfolios have done very well. I'm real happy with 2025. So with that, let's transition quickly to year-end tax planning and how we can save money in taxes. Carol,
all right.
take it?
Thank you, Steve, and hello, everyone. And before I get started, I just want to encourage you as I go along, if you have any questions, to go ahead and type it in the chat. Questions about market update or year-end tax planning, anything. So please feel free to do that, and we'll address that at the end. But as far as tax planning goes, here we are about mid-October. We have about 2.5 months left, roughly, till the end of the year. So this is our window to do take advantage of any kind of tax planning opportunities between now and December 31st. I want to cover, first of all, just some basics so that we can be all on the same page and understand some basic terms and foundations as we talk about tax planning. And then in each season of life, there are different tax planning opportunities. So some, regardless of whether you're retired or working, they apply to all seasons of life. We'll talk about those things. Some unique to just wage earners, and some unique to business owners, and some unique to retirees. All right, let's start with the basics. I like to talk about money. There's like three basic categories of money, and I just call these three tax money buckets, okay? And we are going to refer to each of these in different ways today. So I want to make sure we all understand what these are as we go forward. So first of all, we have the after-tax money bucket. This would be, you guys have earned some income, some business income, wages, you paid your taxes on it, and you have some money you have put into some type of savings. It could be a savings account at the bank, or it could be a brokerage account where you have stocks, bonds, mutual funds, bond funds, etc. And the way this bucket is taxed is that the investment earnings on the money is taxed in the year it is earned. So if you have a savings account at a bank, you earn interest income. That interest income is taxed in the year it's earned. If you have money in a brokerage account, you have dividend income, capital gains income, that is taxed in the year it is earned. But to pull money from either of those types of accounts or after tax bucket does not in itself create any kind of tax event. So that's the after-tax money bucket. You also have, some of you have a pre-tax retirement money bucket. What this is they are retirement accounts of various types where you put money into them before you pay tax on it. So using the example of an employee, you earn wages, but you tell your employer you're going to make these contributions pre-tax. They pull it out of your payroll, put it in the 401k, 403b, etc., before you paid tax, and they actually reduce your taxable wages. So that's the pre-tax, we call it qualified money bucket. The third bucket is the Roth retirement money bucket. So this is using the example of a wage earner or business income, it doesn't matter. You earn money, you pay tax fully on it, and then after that, you make contributions to a Roth 401k or a Roth 403b or a Roth IRA. The way these two buckets are taxed is different. So the pre-tax bucket, when you pull the money out, it's taxed as ordinary income. Whatever, if you pull out $1,000, you pay tax on $8,000 at your ordinary income tax rate. Roth money is different. When you put money in to your Roth accounts, that grows tax-free forever. So you have tax-free growth forever, never pay a penny tax. When you pull it out, you don't pay tax. If your kids inherit it, you don't pay tax. So it's a nice tax advantaged retirement account from that perspective. So those are the three main, tax money buckets that we'll talk about today. There's also life season money buckets, or what I call life season money buckets. So generally, you're going to be either pre-retirement or post-retirement. If you are pre-retirement, you are earning income. You have two types of earning buckets for your income. One is if you're an employee, it's wages. You get a W-2, it's pretty straightforward. If you have a business, an LLC, a sole proprietor, a partnership, rentals, you have business income. And in post-retirement, you also have two sub-buckets of sub-money buckets, if you will. In post-retirement, you may get your money completely by pulling on your retirement account. So you get a monthly amount that comes straight from your retirement account, or you may have retirement money coming from fixed income like a pension, Social Security, annuities. And just to be clear, in post-retirement, you probably have a mix of both at some point. So, or have both. You're likely to have both. In pre-retirement, you may have both, or you may have only one or only the other. So we'll talk about these various life season money buckets as we talk about planning too. Another really basic key concept is, and a lot of tax planning comes out of understanding tax brackets. So you guys know there are multiple tax rates and there are different categories. So if you're single, there's certain rates that apply to your wages and your income, your taxable income. If you're married filing jointly, not generally, the single filer tax rates are half of married filing joint. But here's a concept I think people don't always fully understand, that it's actually not all your income is taxed at the same rate. It's very much like a waterfall. And if you can see this waterfall, money filling up the top bucket, when it's full, it spills into the next and so forth. Your your tax rates and the way your income is taxed is the same way. So in this example, we have a taxpayer that's earning $250,000 of ordinary taxable income. So the money is first pouring into the 10% bracket. When that's full, it spills over into the 12%, and then the 22, and then the 24, and so on. For this particular example, their income partly fills up the 24% tax bracket. So what that means is, when we talk about marginal tax bracket, that's what I just want to define here, because that does matter when we're talking about tax planning. For this individual, their marginal tax bracket is the 24% tax bracket. It just means that the next dollar of taxable income that they earn will be taxed at 24% for federal purposes. And a real key but very basic concept in tax planning is just taking advantage of the tax bracket. So in this individual, they have not filled up their 24% bracket. If we want to do some kind of tax planning strategy for them that increases their taxable income, they have room here, and we'll watch this. We won't want to create any income that bumps them into the next bracket, but we may want to really take advantage of their 24% bracket that they are in. So the brackets are important, and your marginal tax bracket definitely matters. All right. This is also pretty basic, but people do get confused between adjustable gross income and net taxable income. So adjustable gross income, your wages, you get a W-2, pension, 1099-R, same with IRA draws, investment income, business income. That all is considered adjusted gross income. From that, on your tax return, you have deductions. If you itemize, these deductions are things like your state and local taxes, medical costs, mortgage interest, charity. These get subtracted from adjusted gross income and become your net taxable income. This is the number that you are taxed on. So there's gross income and net taxable income. So we'll talk about that as we go forward, and I know it's pretty basic, but just want to make sure we're all on the same page there. All right, let's talk about tax planning that relates to all of you. All of you have the opportunity to potentially take advantage of some of these planning opportunities I'm about to share. So all life seasons, you may be able to take advantage of increasing itemized deductions. So some of the key itemized deductions that you can have some control over: state and local income taxes, medical expenses, and giving. Now remember, if we can increase these itemized deductions, we decrease our taxable income, the net taxable income we just talked about, and that decreases our taxes. So the first area of, a key itemized deduction and a key change in the tax law for this year relates to state and local taxes. So new this year, there's been a big change. And I think it'll just be best if you can just follow me through an example. The law just changed July 4th, and it relates to 2025, the whole calendar. But prior to that, let's look at an example of how it was done. Mortgage, so this individual in this example paid $15,000 of mortgage interest. That goes on there as an itemized deduction. They paid $6,000 of charitable contributions. They paid $15,000 in California state income tax. They paid $7,000 in real estate property tax, total of $22,000. So they paid $22,000, but the previous law limited that to $10,000. So this individual under the previous law got an only $10,000 deduction, even though they paid $22,000. The total of all three of these is $31,000. Then it's compared to the standard deduction. This is for married filing joint. The standard deduction is $31,500. It is a little higher than their actual itemized deductions. They will not itemize, they will take the standard deduction. This individual, had they paid nothing up here, they would still get $31,500. So, they're not really getting any unique benefit to their deductions because the standard deduction is a little higher. Under the new tax law that is effective January 1st, 2025, same particulars here, 15,000 mortgage interest, charity, the same taxes, 22,000, but now because the limit on this type of deduction, on the SALT deduction, is $40,000, they get the full benefit of their $22,000 state and local income tax deduction. Now, the total of all three of these is $43,000, which is higher than their standard deduction. So now they are itemizing. Nothing changed in these two scenarios except the tax law. So like in this example, many people will be able to itemize now that were not previously itemizing. So now itemized deductions become more important to look at, and to look at them as a tax planning opportunity you may be able to take advantage of. All right, so with regard to the state and local tax deductions, there's two key things you have a little control over with regard to timing. And by timing, I mean when you pay them. Most taxpayers are cash basis taxpayers. So timing is about when you make a payment or when you receive income, the date of that. And that's why we're talking about this, because we have until December 31st to make an impact on our 2025 tax return. So with regard to property taxes, if you are a homeowner, you have two installments. One is due, coming up here by the beginning of December. You have to pay the first half. But the second half, you don't have to pay now. You can wait until 2026, or you may accelerate it and pay it by December 31st. If you do that, that will become an increased property tax deduction for you on your 2025 tax return. This can also apply to postponing. You may, for example, know I'm going to be in this crazy high tax bracket in 2026, so I want to postpone my second installment. So it goes both ways. Generally, most people want to accelerate, and you have control over that. The other thing some people have control over, those of you that make quarterly estimated tax payments, the fourth quarter estimated tax payment is actually due January 15th, 2026, but you can pay that sooner. So, that gives you some measure of control. Accelerating your state income tax payment would mean you will have an increased state income tax deduction for 2025. The other area on your itemized deductions that you may be able to manipulate a bit from a planning perspective is medical deductions. Now, many of you do not get these, but some of you do. The reason why a lot of you do not get it is that it is subject to 7.5% of your adjusted gross income, which is quite high. You will get whatever amount of medical expenses exceeds that. That will be your deduction. So we do have clients that have this that do itemize and do get to take advantage of this. So let's talk about what could you do? Well, we have, assuming you have some medical bills coming up or due now, you can be sure to pay them by December 31st to increase your medical deduction right now. And often, they have in some cases, you can even wait till January to pay those. So depending on what you want, if you want to bolster your medical deductions now, make those payments early because it's all about when you make the payment. If you know that next year you're going to have surgery, you're going to have high medical expenses, you may want to wait till January 1st to make those payments with your providers. So again, you can kind of gauge what's going to work better for you, but you do have a little bit of a measure of control on that too. The final itemized tax deduction here, charitable giving, there is a lot that can be done with this. Obviously, the more you give, the bigger your deduction and the less you pay in taxes. So let's talk about some opportunities here. I'll cover all four of these things. First of all, non-cash contributions. These often get overlooked, but if you think you are going to itemize this year, this is a great time to go clean out your closet, clean out your garage, take those, items you no longer want to Goodwill or Salvation Army or whoever, and have a non-cash contribution deduction. It actually can end up being a really big win on your tax return. So you'll get a receipt from those organizations, and what you will deduct is the fair market value, your estimation of the fair market value of those household items, clothing, tools, etc. So don't miss that if you think you are going to itemize this year. We'll talk about in more detail timing of cash donations that you make, a tax planning strategy called concentrated giving, and donating appreciated stock. All right, so if you are itemizing, this is where you want to pay attention very closely because this is going to change in 2026. It is not applicable right now, but in 2026, the new tax law says that you will get only those charitable contributions that exceed 0.5% of your adjusted gross income. So just using an example, this is a high earning taxpayer who has adjusted gross income of $500,000. Remember, adjusted gross income minus deductions is net taxable income. We're talking about the gross income here. And this person is giving $7,000 for the year, and 5.5% of their adjusted gross income is $2,500. So what this means as far as their charitable deduction, they give 7, we have to subtract the 2,500, the AGI floor there, and they only get to deduct $4,500. So they do lose $2,500 of their charitable giving as a deduction. So if you are itemizing or maybe itemizing, definitely better to do your giving before December 31st and get the full value of all your giving and not have to be subject to this upcoming 0.5% AGI floor. All right. Another new change that will be effective in 2026 is that for taxpayers who take the standard deduction, they will get an above the line deduction, $1,000 for single filers, $2,000 for married couples filing joint. What this means is that if you are planning to have a relatively small amount of giving, $1,000 or $2,000, and you know there's no hope that you're going to itemize, you are taking the standard deduction, it is actually going to be better for you to wait till January 1st to do your giving for this type of small cash donation, you will get a bigger benefit. Because right now, if in 2025, if you are a married couple filing jointly and you want to give $2,000, you do not get any tax benefit of that if you are taking the standard deduction. So again, standard deduction, $31,500 for married couples, half of that for singles. If you don't have enough deductions, that is what you're taking, and this $2,000 of giving will not change anything in your taxes for 2025, but it will for 2026. All right, I know there's a lot of numbers here, but we're going to walk through it slowly. This is called concentrated giving, and there's two scenarios. In the first half of the slide, this individual plans to give, if you're looking at the green row, this individual has planned giving of $15,000 every year. They have a consistent plan, $15,000 every year for the next 3 years. But for their itemized deductions, all they have is state and local taxes of $10,000, their $15,000 of giving. They have $25,000 of total itemized deductions. If you see that, the top light blue line there where my pointer is, that is less than the standard deduction. Remember, standard deduction here is $31,500. So they get the standard deduction, which is higher, $31,500. They had no tax benefit to their giving. There's a lot of benefits to giving, but they got no tax benefit. So $31,500 standard deduction. Every year, that's what they get because they don't have enough to exceed that. So if the same individual instead wants to bunch their giving, if they have the ability, if they have enough cash to do so, let's look at this second option scenario. The same individual also has the state and local income taxes of $10,000, but they had enough cash to be able to bunch all their giving for 3 years into 1 year. So instead of $15,000 a year, they're giving $45,000 in year 1. Now their total itemized deductions, if you see my pointer, is at $55,000. That is much higher than the standard deduction. So they get the itemized deduction of $55,000. The following year, they have no giving, because remember, they already gave for that year. They get the standard deduction. That's the higher of their itemized deductions, which are 10, standard deduction $31,500. That's what they get. Same with year 3. So how does this play out? Over a 3-year period, they actually have increased deductions of $23,500 by doing this strategy. And using 25% tax rate for federal and state, and arguably many of you are higher than that on the margin, but using 25%, that is $5,875. They just saved $5,875 of taxes. That is the amount that the government lost on them from this strategy. And it's a really great opportunity if you do have the ability to bunch your giving together, if you have an inheritance or a large savings or an extra bonus and you can do this, it's a great opportunity to take advantage of that. All right, donating appreciated stock. So this is only going to apply to those of you that have the after-tax bucket in a brokerage account. Remember, we talked about the 3 tax buckets. If you've paid taxes on your income, you saved money, or you got an inheritance and you have money invested in stocks, bonds, mutual funds, etc., this is a great opportunity for you in relationship to giving. So this scenario, in the example, this person absolutely plans to give $10,000 to charity, but they do not have the cash. They have to sell some stock to get the cash to do this. When they sell stock, there are some gains and they're going to have some taxes to pay. So what they're going to do is they are going to sell stock that is valued at $11,458. The cost basis of the stock they are selling in this example is $5,458. That's equivalent essentially to the purchase price when we talk about cost basis. So the gain on the sale of this stock is $6,000. They have to pay tax on this. So the tax is $1,458, given the tax rates we noted above. And now they have $10,000 of cash to pay to the charity. But what did it cost this person to do this $10,000 of giving? It actually cost them $11,458. These two numbers combined is the cost to them. Charity gets 10. That was their goal, remember, to give the charity 10. Alternatively, they could donate the stock directly to the charity. $10,000 of stock goes directly to the charity. They have no gain they have no gain incurred, no tax. They pay zero tax on this. The charity gets $10,000 and it cost this individual $10,000 because they have no tax. So this is a great strategy if you plan on giving and you have stock positions, bond positions with appreciated value in them. The stock must be held at least a year for this to be an option, only long-term stock. There are some limitations, but this is a great option for most people in this with this kind of tax, the after-tax bucket. All right, let's talk about tax planning for wage earners, employees. And spoiler alert, there is not a whole lot. This is the hardest category as far as tax planning opportunities. So we've already talked about what you can do. So your only source of income is wage income. You still can do what we have talked about by increasing your itemized deductions. So that's good. But what can you do about your income? I mean, you're getting wages. Wages are wages. Really, the only thing you can do with your income is defer it. And what that means is if you are not already making maximum contributions to your 401k on a pre-tax basis, or 403b on a pre-tax basis, or deferred comp plan, or a tax deductible IRA contribution if you're eligible, if you're not already maxing that out, you can increase your contributions and that will decrease your taxable income. So you have that definitely as an option if you are not already doing so. What that looks like, just as an example, assume you get $100,000 of gross wages. You pay on a pre-tax basis contributions to your 401k of $23,500, which is the maximum for under 50. If you're under age 50, this is your maximum for 2025. That leaves taxable wages of $76,500 that are reported on your W-2 and tax return. So that, it's nothing fancy there, but if you're not already doing it and want to decrease your taxable wage income, that is an opportunity for you. I do want to make this disclaimer, though, that it is not a one-size-fits-all. So we look at lifetime taxes and lifetime tax savings. So definitely, if you make a pre-tax 401k contribution this year, it will absolutely reduce your wage this year. But if you are really young, you have a long time horizon to retirement, if typically young people have lower income, and as they get more experience, their income grows in their profession. If you're in that situation, it still would likely save you lifetime tax dollars if you do Roth 401k contributions, Roth 403b contributions. I want to just say that because it is not a one size fits all. And many of you have young adult children that have been wondering these things. Roth contributions are absolutely excellent when you think about lifetime tax savings, because remember, those dollars grow tax-free forever. And if you're 30 and making retirement contributions, and you're not going to retire till 65, and you're not even going to be pulling all of that out right away, you've got decades of growth. So just keep that in mind. that it is not a one size fits all, like I said. All right, tax planning. For those of you that have business income, there's a lot more that can be done in the context of a business. So let's take a look at that. Business income, that can be side hustles. It can be rentals. A lot of you have rentals. It can be a side hustle, self-employment, or a full the full source of all your earned income may come from business income, self-employment, partnerships, LLCs. When you are in any of those situations, you can accelerate or delay income, and you can accelerate or delay expenses. And we'll talk more about that. You definitely have some opportunities that wage earners do not have. Now, remember, business income, as you guys know, you who are business owners know this. It's quite volatile. You have good years, you have bad years. If you find yourself in a year right now that it is a low income year for you, you are in a lower tax bracket than you usually are. Let's take advantage of lower income and how to do that. So, couple things. You can accelerate income to the current year, and you can do that a few ways. You can advance business income, capital gain harvesting, and Roth conversions, which we'll talk more about. You can defer expenses to higher income years. So as far as accelerating income to the current year, often with your businesses, you can incentivize, your clients, your customers to pay before December 31st. You can try to collect more income now if you, depending on the type of business that you have. So you can have some measure of control, a little bit of control in some business scenarios to do this. Another way, though, that you can accelerate income into the current year is capital gain harvesting and Roth conversions, which we will talk in a lot more detail about here. So capital gain harvesting, if you are in a low enough tax bracket, your income, your taxable income is less for married filing joint, less than $96,700, and half of that for a single taxpayer. You are in a 0% capital gains tax rate for federal purposes. And what you can do is, and you're going to have to, you have to watch this number very closely, but you can sell positions that cause gain to be realized, meaning you're now going to be taxed on it, and rebuy the same position. So if it was Apple stock that you sell for $10,000 and it has a $5,000 gain, you're in the zero capital gains, you pay no tax for federal purposes, and then you rebuy Apple stock on the same day. That's what that looks like, just using a little example. The other thing we do for tax planning, and we do quite a bit of this in our practice with our clients, is a Roth conversion. So what is a Roth conversion? Remember our tax buckets, our tax money buckets. Okay, one of the tax money buckets is your pre-tax retirement money. If you have a pre-tax IRA, a traditional qualified IRA account, you can pull some money out of that, move it over to a Roth IRA account. You will pay the tax on that. So you pull $50,000 out of your pre-tax bucket to your Roth bucket, you pay tax on $50,000. And you may say, why do I want to pay more tax? There's really good reasons, and we'll go in a lot of detail on that in just a minute. But in general, the reason why is that once you put it in the Roth money bucket, it grows tax-free forever. There's no required minimum distributions later in life, which the pre-tax retirement money bucket has. Once you start 73, the government makes you take money out, but not for the Roth retirement money bucket. So you will never pay tax on anything you pull out of your Roth retirement money. As long as it's in there, it's growing tax-free. So it's a great, great, great tax planning opportunity for many, not for everyone, but let's look at an example so you can see how this has played out. This chart is a graph of taxable income from the current year, 2025, to end of life expectancy for this couple married filing joint. This couple in this example is retired, currently retired. And just to let you know how this chart works, each bar here is taxable income every year for the rest of their lives, estimated taxable income. The different colors are different types of taxable income, but each bar, the height of the bar is the amount of taxable income. These horizontal sloping upward lines are the various tax brackets. So there's a blue line here where my pointer is. That's the beginning of the 12% tax bracket for this married couple. The green line here is the beginning of the 22% bracket for this couple, and the purple 24%. In this example, this couple has some money in an after-tax bucket that they are living on. So their taxable income is very low for 3 years. As you can see here, it's just extraordinarily low. But they go through that in about 3 years, and then in this couple's case, they start having required minimum distributions from their traditional pre-tax qualified money. They have to pay the tax on it when they pull it out, and they have required minimum distributions. The green is what that is. It grows as they get closer to end of life, and you can see it's bumping their income higher and higher and higher. So what these lines, these big drops right here, this represents, this is a married couple, and just using life expectancy, one of the spouses has reached their life expectancy. Now there is a single taxpayer. The single taxpayer is now bumped into much higher tax bracket. Right here, you can see they have substantial amount of income in the 24% bracket. So we call this, it's referred to a widow's penalty. It is just very hard hitting because you can see that when one spouse passes, the income does not change that much. In their case, the only thing that really drops is Social Security. Everything else is pretty much the same. So the taxes hit pretty hard. In this case, if they do 6 years of Roth conversion in filling up not only the 12%, but also the 22% bracket for these years, look at what has happened to their income and how it has dropped substantially in later years. Again, just to kind of compare, this was without Roth conversion. Even over here, you can see it's high, and then it's really high in here, and now much lower. The Roth conversion did that. But here's the real kicker, I think. This is how much lifetime tax savings that they saved in current dollars, $151,000. This is huge. So huge. It just really, not everyone's going to have such a high number, but this is what we look at when we're doing tax planning. But when we say, we're making a Roth recommendation, it's because we have run these calculations to see if in any one particular situation, if it makes sense. And clearly the answer was yes for this couple. I have a quick example of an individual, because it's not just married couples and widow penalties. This is a single taxpayer, also retired, also has money in the after-tax bracket that she is living on in these first 3 years. So very low income, low taxable income, I mean. They're living on the after-tax money, so they still are living. And then, after a few years, they start taking draws on their IRA. They start she starts Social Security. This is a single taxpayer, sorry. And then eventually required minimum distributions is the green. You can see that once those required minimum distributions hit, her income is being bumped in significantly into the higher bracket. Let's look at what happens if we do Roth conversions. Look at this, just 3 years, filling up the 22% bracket for her. All of this has dropped. I mean, so substantial. And in her case, the lifetime tax savings in current dollars, 114,000. So it's still very big, but it works for single, for married. You just got to run the numbers. Again, not 100% of people have a situation that yields this kind of result, but we do look at that, and it can be an amazing strategy for many, many people. All right. What if you're a business owner and your income is unusually high this year, 2025? So what can you do? You can accelerate expenses, pay those expenses by December 31st. There's a lot you can, if you are thinking about it, and I've done it even just with some rental income that we personally have, you can actually make sure you take care of any projects or big expenses by December 31st. Or if they're not quite started, but you've already hired someone, you can prepay. Again, the date you make the payment is what counts. So think about, what can I do to accelerate my business expenses so that I can pay things by December 31st and capture them for 2025? The other thing you could do is postpone collecting income to January 1st. If you have big clients, big customers, you could say, hey, don't pay me until January 1st. There's often opportunities to delay income a little bit. And then you can also, if you in your business have a retirement plan, a 401k plan, you can maximize your retirement plan contributions. If you have a pension in your business, gives you even greater opportunities to do this. So take advantage of that as well, because that will reduce your taxable income too in the current year. And lastly, for retirees, this is unique to retirees. What can you do that's unique to your life season? So a key thing for retirees, many of you have funds that are in the after-tax money bucket. So you may have gotten an inheritance at this point in your life. You may have just saved well and invested in a brokerage account. If you have after-tax bucket money, you have an even greater opportunity to do tax planning, because you can keep your taxable income so low and take even greater advantage of some of the things we've talked about, Roth conversions and harvesting capital gains. We've already talked about, so you're a retiree, Roth conversions is an option, harvesting capital gains is an option, donating appreciated stock, concentrating giving, all those still apply to you potentially. But new and unique to just you, if you are 70 and a half and over, you can take advantage of something called qualified charitable donations, QCDs. So let's talk a little more detail here with an example on this. So assume this person is 71. They are going to pull money out. So we're going to pull money out of your IRA and pay cash for a contribution versus a qualified charitable distribution. So if you're pulling money out of your IRA, you're pulling $7,278 because you've got to pay some tax on this. If this person wants to give $5,000 to charity, that is their planned giving goal. These are their rates. The marginal tax rate, 22% Fed, 9.3 California. That's 31.3 total. And we are assuming they don't itemized. They have no itemized deductions. So here's their scenario. They're taking out $7,278 out of their IRA. They are paying tax. So taxable income on that, what is taxed, is $7,278, ordinary income. The tax on that is $2,278. And now the charity, they can write their check, make their payments to the charity of $5,000. But what did it cost them to give $5,000? Was a total of $7,278. That's the cost to them of giving $5,000 in this scenario, while they had to pull money out of their IRA account and then pay cash. Alternatively, what they could do is have the $5,000 sent from their IRA retirement account directly to the charity in the form of a qualified charitable distribution, $5,000. So charity gets $5,000 and they pay zero tax. So it is a great strategy if you are 70 and a half or over and have some planned giving or want to give. It's also something you can do with your required minimum distributions to even meet your required minimum distribution in some cases. So great opportunity there. In conclusion, these tax strategies certainly are not comprehensive. There's lots more we could talk about, but they do cover most situations. There is a lot of complexity in it, though. So if we're doing something that creates more income in the current year, that can change your taxation of overtime. It can change your taxation of tips. It can trigger phase outs, credits, deductions. It can increase taxation of your Social Security. Your Medicare premiums can be increased because of this and more. We're looking at all of these things when we do tax planning. We recommend, this is not like a DIY thing. Typically, you need someone who has tax planning capabilities and software to model these things, which we have, or your CPA would have that. And that's important and essential so that you don't inadvertently cause other problems, and that you can calculate the optimal amount for your strategy. And another thing I just want to say in concluding too is that oftentimes, when should you contact us and have us do some tax planning or at least consider tax planning opportunities? We do consider them when we do financial plan updates, but also when you guys have big changes in life, that's a great time to contact us. Like you're selling a home and now you have a lot of cash, or you got a really large bonus, or you're moving. Life changes can be triggers for some new tax planning opportunities. It can be very important. Even timing of maybe you need money for an emergency and we can kind of work out the best distribution strategy from a tax planning perspective. All of those things are great reasons to contact us if and when they happen. So all that being said, that is the end of my tax planning presentation. And Steve, if you have any
Thank you.
questions.
Yeah, thank you so much, Carol.
Absolutely.
I guess at this point, what I would ask is if you have any questions, please type them in the Q&A section. And while you are typing those in, let me just expound on when you should contact us. Certainly, we go through these webinars and we gave you a lot of information. So it's not our intent that you become experts on this. Obviously, we're here to help. But I hope that armed with this information, that you can then help us identify ways to help you, right? So if you're, for example, a business owner and you have high income this year, that should be a trigger. Give us a call. Let's talk. We could develop some of these strategies, look for ways to help you in that. Similarly, if you're a business owner and you lost a big client, or you just having a down year, and you have a low income year, from our perspective, that's an opportunity. And what we find often is that CPAs are more about compliance. They want to record and help you stay in compliance with the IRS rules, which is great. But many CPAs don't do any advanced planning like this. Certainly multi-year planning, such as this Roth conversion analysis that we've discussed. And so we're here to help. If you have items like this, if you inherit some money and all of a sudden you have a big after-tax windfall, from our perspective, that's just fun. It opens up so many planning opportunities. So please give us a call.
And I am seeing some questions in the Q&A as opposed to the chat. One attendee is asking, interesting, what would happen if you invested the other years of giving? I presume that this person is referring to concentrated giving. So hopefully I'm on the right track with what you are asking here. In this scenario, hopefully I'm getting it right. I know, Steve, do you want to touch on that?
Yeah, I
Or
mean, I guess I can address that. It's a tough question, right? I think the answer is, well, if I'm giving $45,000 in year one, um, aren't I foregoing the investment return on that money? And you know, the answer to that is yes. I mean, if that is a concern, frankly, you could still use concentrated giving and just flip this around, right? You don't have to give the money in advance. You could hold on to your cash, keep it invested, grow it, and then give the money in year three, right? So the real key here is that there can be
right.
some real benefits to giving in large chunks just because of the way the tax code is written. And so that's really the key message.
Yeah, yeah, thank you, Steve. And another person asked, what if only one of a married couple is 70 and a half and they filed jointly? So I'm going to get over to that slide. Talking about QCDs. So just for reference for everyone, for a QCD, it comes from an IRA account. The IRA account is individual specific. So um, it would be applicable only for the person that is 70 and a half and their IRA account. So each, with a married couple, each of you may or may not have an IRA retirement account, depending. Often you do. Often both have an IRA account. But the one that is eligible to do a QCD strategy is the one that's 70 and a half or over. That may be both of you, but if in this question they're asking if only one of you is, that person can do the QCD out of their own individual IRA retirement account. Now, Steve, did
Yeah.
you want to add
Yeah,
any
no,
thoughts?
it looks like we've got a couple of questions on that. So I think you explained that very well, Carol. So it even though you're married filing jointly, the way the IRS rules work is those IRAs are actually owned by each of you as an individual. And so you would be eligible for QCD for your IRA based on your birthday. Yeah.
Yeah. So yeah, and I see that other question, and yeah, it was a great question. And yes, it is good to keep these things in mind all year long. We have, roughly 2.5 months to think about what you can do now going forward. And this is often a time where bigger strategies like Roth conversions and, um, you know, harvesting capital gains. This is a great time for things like that. But yeah, good point to be thinking about it all year for sure. So I don't anything else, Steve, or
Well, I think that's all the questions that I'm seeing.
yeah.
But before I let everyone go, let me just give you a little bit of a preview of next quarter's webinar. I'm actually quite excited about it. So we're planning on walking through a process to help each of you write a legacy letter. And we'll talk more about what that means, but it will be a little bit of a different webinar for us. It's and so please don't miss it. Look for information on that. But in the meantime, please reach out. And if you have any questions regarding year-end tax planning, we're here to help. Thank you all so much.
Take care. Bye bye.
Bye-bye.